Good morning, everybody. Thank you for joining. On behalf of all the panel members, welcome to this panel, Overview and Status Quo for Benchmark Reform in the Australian Context. We have a very interesting panel with members of very diverse backgrounds. I won't go through the individual bios, but we have Ross Allen from IHS Markets Information Technology. We have Greg Casper from Westpac Bank. We have David Love, representing the Australian Financial Markets Association. And we also have Alexander Bond from Murex Information Technology. Hopefully we'll have a good panel, and I'll address the first question to yourself, David. LIBOR discontinuance. We know it will disappear in early 2022. Are you able to sketch the features of the environment? What does this mean for Australia? What is being done about it within AFMA, and what have been some of the guidance and the broader framework within the Australian context?
A lot of questions to cover in a very short time, Peter. Thank you very much, and nice to be here. Australia is very much on travelling on this journey as a follower of the major jurisdictions. It's really the change, the move away from the LIBOR rates has been driven particularly out of the United Kingdom through decisions made at an official level, as well as the United States, which is very keen to repatriate control of its own benchmarks to bring them under US jurisdiction. These jurisdictions in particular have driven then the decisions about the timing and the pace of these changes. Australia, as an open economy, has to react and follow these effects, and has to be able to prepare and be ready to deal with the really many matters which are not under our direct control. However, it has been clear for the last 3 years that these events were coming, and considerable preparations have been done leading up to the end of 2021, when they set this putative date for the official sector no longer supporting submissions to LIBOR, which may bring it to an end. As a result, here in Australia, our position is somewhat different with regard to the so-called LIBOR rates. We have here the BBSW rate. It is a continuing rate, and the way it is spoken of in Australia is that we are a multi-rate jurisdiction, in that the official sector is continuing to provide support to the continuation of this rate into the future. However, this should not encourage complacency amongst people, and probably the biggest issue that we've had to face in Australia is a sense, particularly amongst users of the rates on the buy side, that this was fundamentally a problem for the banks and for those engaged in major transactions in the other jurisdictions. As we know, and we'll come to in discussion today, there'll be discussion around how the external environment is affecting Australia, how particularly with cross-currency swaps and other areas like that, we cannot isolate ourselves from these changes. There is also a feeling too that there are vulnerabilities. I won't overplay those with the BBSW, so nothing can be certain in this environment at all. That's what we've come to expect for many years. So here we have a situation where we've been well prepared with regard to our alternative reference rate, our risk-free rate, the couple of terms that you'll come to hear in this discussion. In Australia, it is the cash rate administered by the Reserve Bank of Australia, which is also known as the AONIA. These terms are one and the same thing, and that's a very important thing to bear in mind in the Australian context. I might note that Australia, the work here on the private sector has been led by the National Working Group, chaired by Peter Birkins here today, as well as which also has Greg Casper on that group. That is the Australian Transformation Working Group, and that is the equivalent nationally. I think at that moment I might just leave those contextual matters, and we'll come back to some of the more details later, Peter.
Sure, that's very helpful. Thank you. Thank you, David. That's interesting, your comments around BBSW and the two-rate approach they have in Australia, and I think we're going to get back to that later on in the panel. Greg, you look after a big piece of work, the transition from LIBOR away to risk-free rate within Westpac. Can you talk us through some of the key challenges you're facing, particularly the ones that maybe you hadn't anticipated when you started on that program?
Sure. Thanks, Peter. We've been working on IBOR transition for quite a while now at Westpac, and I think one of the things that surprised us and continues to surprise us is really the breadth of scope of the project and how far these benchmarks actually go within the organisation. So we've had to find subject matter experts in a lot of different areas of the bank, including issuance teams, derivatives users, lenders, and across the board from front office, technology, finance, operations, legal, the list just goes on and on. So it really encompasses all areas of the bank, and you need to be prepared to engage all of those stakeholders when you're embarking on this project. Another significant challenge which we had was the fact that it was especially different for a lot of the project people involved was the goalposts aren't really fixed in this project. So there's a lot of uncertainty around what products we need to develop, what the timelines are going to be, when we need to have everything ready by, and those things are shifting around quite a lot. So setting up sort of plans and deliverables in that sort of environment is really challenging, and it's something that's new for a lot of the project people. And it's going to continue like that, I think, for quite some time, where we don't really have certainty over when some of the benchmarks are going to disappear. We don't really have certainty around things like pre-cessation, again, something we'll probably talk about a bit later, and where the market is going to gravitate towards in terms of conventions and the products that are going to be traded in a post-transition world.
That's very interesting, Greg. You sketch an environment of lots of moving parts, lots of stakeholders, interdependencies, uncertain outcomes, uncertain timelines in some ways. Well, we do know LIBOR most likely will discontinue, but that's within that a lot of uncertainty complicating the task. Very interesting. Ross, if I can ask you a quick question on the ISDA fallbacks. They've been published recently. They were launched last Friday, as many of us on this call will be aware. Talk us through some of the implications of that and what some of the perhaps less obvious aspects of those fallbacks might be.
Yeah, thanks, Peter. So as you state, the ISDA fallbacks were released last week. I think a very important step in the transition program. Probably important to note that obviously they impact derivatives, not the loans and bonds exposures. Just to clarify. But fundamentally, the fallbacks add language to derivative contracts that ensure that there is a rate available if the LIBOR rate isn't available at a future point in time. So it's an important protocol to put in place to essentially provide a safety net, which I think is how ISDA have kind of referenced it, if the LIBOR rates aren't available at a future point in time. So I think for me, the kind of important piece here is it's a framework that's been developed. It's obviously a global framework, and it's something that the industry can rely upon as that safety net to ensure that they have something in place if the LIBOR rate isn't available. Now, that's not to say that you shouldn't be more proactive in thinking about how you transition from your existing exposures to risk-free rate-based exposures, for example. But that safety net does exist, and it gives you maybe a little bit of comfort that you've got that fallback in place. I think when considering kind of how it affects the banks, obviously, we really are seeing now the banks outreaching and educating their clients and their users around the transition for different types of products and dealing with some of the operational and execution challenges of the redocumentation, which I know is going to be covered in a little bit more detail on tomorrow's panel. But certainly, one of the aspects that I think is an important area there is around conduct and how the banks really are kind of systemizing that outreach process to their clients and making that firstly an efficient process to handle this repapering, but also importantly to have an audit trail around that so you can gain comfort that you've got any potential conduct related matters well documented and well handled. Then on the flip side, on the buy side, these use of protocols are an effective tool for helping those buy side participants to have that safety net for their derivative exposures with different counterparts that they may have. But as I mentioned, this, isn't a tool that should be used as a transitional tool as such. Really, this is a safety net to have something in your contracts if the LIBOR rates aren't available. What it should allow you to do is have that safety net and then be proactive on the trades where you do have economic impact due to value transfer. So really focusing in on maybe the small handful of trades within your portfolio where there's a significant economic impact, and then you can look at bilateral negotiations to transition those trades that have an economic impact. So that's maybe a slight kind of nuance on how to think about the fallbacks, but certainly for me, it's a starting point that allows those buy-side participants to kind of source additional kind of advice, data, to be able to help them with that transition for the key trades where they have value transfer impact or economic impact.
That's a very interesting point. Well, so if I could just have as a follow-up, are you able to sort of sketch which types of contracts might have that value transfer issue?
Yeah, look, I think, certainly as you get into the longer dated swaps, you're going to see much more potential for value transfer. I think we're going to talk a little bit later around valuations in the panel. But certainly, if you look at the fundamental difference between an IBOR and a risk-free rate, they're clearly quite different. And the spread between the LIBOR rate and the risk-free rate is not static, it's dynamic, it changes over time. So even if you can assess your portfolio today, you may see a difference. But you've really got to monitor that over time to make sure that you're making good decisions around the transition, but also the timing of transition in certain trades will be important to that kind of economic impact. So I think we'll touch on that a little bit later, but those longer dated trades, obviously there's a little bit more kind of risk there.
Very interesting. Thank you, Rob. Alex, Murex Financial Technology. Talk us through some of the financial technology adoption strategies that you've witnessed on the buy side amongst your clients, and are you able to sort of sketch perhaps a difference between the preparedness across various regions as well as you look at your portfolio of clients in the regions and beyond that, and some of the challenges they may face?
All right. Thanks, Peter. I'll touch maybe a bit more broadly of sell side and buy side, because we have a fairly large sell side client base in Asia. But so there are obviously common themes across the regions, like a significant exposure to US dollar LIBOR across all market participants. And I think also all the key issues that Greg just highlighted are common to most institutions in the region. Now, there are obviously differences between firms and regions, and as well between types of firms. Wherever we go, we see the sell side and the larger banks to be more advanced in their preparation than the buy side and obviously corporate treasuries. And so differences, yes, be it in terms both of levels of preparation, but also in terms of key focus areas. If I go back and in the region, I think the larger firms in Australia and in Japan on the sell side have probably been the one leading the way in that transition process for the region. And from what we can see, our clients in Australia and from other G7 countries have quite similar approaches and concerns. For instance, there's been a lot of focus on the recent CCP big bang discounting switch, which was probably less of a concern with Asian banks in general. Also, we've seen Australian firms bring up questions around valuation on non-linear positions on RFR indices and question around transition of those complex derivatives, more or less around the same time as their European counterparts. So we see more the similarities there. And then I think outside in Asia, we also have places like Singapore and Thailand, where the local major benchmark will be discontinued together with US dollar LIBOR. And that's because these synthetic FX implied indices are actually derived from that benchmark. So when you kill US dollar LIBOR, you kill those indices. And so obviously there, the priority is on developing a market for these, for their new alternative rates, and on managing the fallback mechanisms for their legacy benchmarks, which gets actually quite complex when you get into details. Overall, I think Aussie firms are in a more comfortable position. BBSW is not going away so soon. Aonia is an established index with a well-developed market, which helps a lot. It's a very different situation in Hong Kong, for instance, which is another multi-rate jurisdiction, but it's struggling really with the adoption of their new HONIA rate, for instance. There's also a jurisdiction where, to pick on the point that David hinted at, where the understanding of what's going to be the new norm in terms of convention for cross-currency basis swap is clearly not as advanced as we are seeing now in Australia or Japan, which face a similar problem, but where I think the maturity of the reflection is higher. So finally, I think we can say that across the region there are, I mean, at least from our perspective on the system side, and if you focus on derivatives, there are two main common challenges for everyone. The first is the adoption of the new RFRs. We need to create new products referencing these indices and build this market in very little time. So there's one issue there that I see that market participants lately have been very creative. We see a multiplication of conventions and product variations. So to me, the lack of product alignment on the product terms there between cash and derivatives especially, but also within one asset class is a source of concern. And then we have the elephant in the room that Ross hinted at, which is how will we operationalize the transition of legacy LIBOR referencing contracts across all types of products and for all market participants, be it either through early transition arrangement or the adoption of fallback mechanism. And this, again, comes with issues across legal conduct, valuations, obviously, but also systems, operations, accounting, you name it. So I'm rambling, so I'll stop at that point. I'm sure we can come back to that point in the discussion.
Well, there's just so much aspects to it, so much interdependencies, and not too much time. David, 14 months from now, we're going to be in January 1, 2022. The FCA will no longer require banks to put up with their LIBOR rates. And that's how we got into this journey of transition and redocumentation, all the challenges that it entails. Is there any likelihood or possibility or flexibility around that specific timeline from a public sector guidance standpoint? Are you able to comment on that?
I think the message has been very clear that the authorities in the UK, the FCA in particular, have been, and the Bank of England have been holding the line on this. The question is, there was quite a lot of discussion at the time of March, April, when COVID came in and everything was thrown into disarray about the possibility of delays. The regulators were very clear in the UK that they wanted to keep the momentum up. They felt it was critical that the momentum kept up. There has been some leniency shown in more nearer term deadlines, but they are sticking to the view that the official support will be pulled from requiring banks basically to make submissions to LIBOR, on the basis that they have the view, and there's been a similar view expressed in the United States as well from the officialdom, that these are now very, very fragile rates. And they are just, even within themselves, the sustainability mechanisms are not there. So regardless of even what the authorities may believe with regard to what they can and can't do, they keep pointing out that the things could come to an end just by themselves. And this is why, for those who've been aware of documentation discussions, particularly by ISDA, why the question of pre-cessation was such a big matter in the marketplace. That's trying to deal with the issue of what happens if a rate just simply peters out, regardless of what the public sector says. So at the moment, I don't think there can be any sense of the regulators will let this run and they'll just extend it last minute. You can't expect that. You can't plan for that. some things may change, we don't know. But as I said, as far as planning is concerned, the momentum's up. Again, in Australia, we have a different situation where we're not under those sort of deadlines. But again, because we are dealing basically with an open market where particularly we have to do a lot of the cross-currency swaps and the issues that Alexandre and Ross have been pointing out with regard to the valuation issues when you're trying to deal arbitrage between a term rate with credit risk in it, and these risk-free rates. All those questions sort of come up and can't be sort of ignored. They need to operationalize this. So I wouldn't suggest to anybody that they think that they might be saved by the regulators at the last moment. Who knows what will happen in 12 months' time, though.
Very interesting. Thank you for sharing that, David. Obviously, when COVID hit first, I thought it was interesting to see how you saw a LIBOR rate really disconnecting from the official rates, if you will, really emphasizing this point that there is that difference between the path of official rates and risk-free rates versus LIBOR rates. And certainly from the regulatory publications that were out there, emphasizing the point that it illustrates the attraction, if you will, of not being exposed to bank credit risk, because the rates remained quite high for some time, even though official rates had been cut. Alex, the transition timeline we just talked about, but there's also this discussion around the FCA making an announcement, maybe as early as later this year, in effect calling time on LIBOR, telling people, yes, LIBOR will discontinue at a certain time in January, definitively stating the end of some or all LIBORs. What's the latest on that, and what's the importance of any such announcement, and will it be made across all the jurisdictions?
Yeah, thanks, Peter. Well, the latest is that I think there is almost certainty now that the FCA is going to make such an announcement. And when the FCA makes an announcement about either LIBOR cessation or the non-representativeness of the LIBOR, this is going to be a pivotal event in this transition, as it will bring that much needed certainty to the market. So first of all, it's going to confirm that the cessation is happening, and will give us all a date to work with. So there are still market participants out there who are stuck at the denial step of the 7 stages of grief of losing LIBOR. I think this should help them move on. But then from a certainty point of view, it's also really helped because it will immediately crystallize the adjustment spread that is going to be applied in this ISDA fallback mechanism due to the way it's going to be computed. So from then on, there is really no reason to keep trading new LIBOR instruments, because entering a new LIBOR swap would just give you a SOFR instrument, for instance. But because of the fallback technicalities, that trade can at times be slightly misaligned with what you would have with entering a new SOFR instruments instead of going through the fallbacks. So that's a little bit annoying from a hedging perspective. So you better ditch LIBOR altogether then. From a valuation point of view for these LIBOR positions, this also means that your revaluation curves become a kind of a dual regime curves, with LIBOR instruments on the short end, SOFR instruments on the long end, and with a kind of sudden jump or a little cliff effect at that future trigger date. And modeling this neatly requires a bit of work, especially around the question of risk projections. Now, you can tell me that today, this transitioning effect is actually already largely priced in market quotes, but it's kind of smoothed out over a period of a few months, and the spread also is quoted within a range of likely values. So at the time of the announcement, we'll likely see this collapse into this jump, and then it will gradually fade out over time. Now, what I think is the big remaining question is which LIBOR currencies and tenors will be impacted by such an announcement. One likely scenario is going to be that they'll announce it for the least liquid tenors of the GBP LIBOR, because the market is relatively ready there. Maybe some US dollar LIBOR as well, nobody knows. And now a partial announcement would let the market transition by blocks and avoid a big bang kind of transition. But it also will create a lot of additional operational and technical challenges, especially around the implementation and management of fallbacks, with a lot of complexity for systems. So I hope that we can avoid really a multi-step tenor by tenor transition and slow agonizing death of LIBOR. You could have also a big bang by currency, which would also raise some questions, like how you manage your cross-currency basis swaps, for instance. But I think still it would be operationally much simpler in that case.
That's very interesting. So it sounds like this that expected announcement. We don't know exactly when it's going to be announced, do we? Is it to be later this year, early next year? Is there a intended transition in connection with the operativeness of the LIBOR fallbacks, or is that unclear at the moment? Alex, are you able to?
The latest declaration from FCA officials seems to really hint that this is due to happen this year. So there was a bit of speculation early on whether or not they will wait for the end of the ISDA fallback adoption period before making such an announcement. But I mean, they made some declaration, and it really seems that it's going to happen in December or even late in November. But I think December is probably the most likely case. But the scope of what is going to be impacted is really the question.
Ross, you mentioned earlier in the context of the ISDA fallbacks and some of the valuation issues, you concur with Alex's view into some of the risks and some of the changes of the transition and the valuation that such an announcement might actually entail?
Yeah. I think the points that David and Alex made are very valid around both the timeline and the valuation impact. I think, what I always fall back to when thinking about this and trying to kind of simplify the problem, if you like, is, clearly the fundamental difference between your IBOR rate and your risk-free rate, and, the dynamic spread between the two. And then looking at the market volatility that we've experienced in the last 12 months, you see such a disparate kind of performance of those underlying reference rates that, as a prudent measure, you've really got to be assessing different scenarios for your transition for different parts of your portfolio, and really looking at, what would be the valuation impact of using the fallbacks, what would be the valuation impact of transitioning at a particular point in time. So I would certainly be encouraging, particularly participants on the buy side, to be really understanding what this means for their portfolio. And for maybe a large percentage of their portfolio, maybe there's a relatively small valuation impact or value transfer impact. But for certain parts of their portfolio, for certain trades, it could be material. And being able to concentrate on those particular transactions and migrate by doing the scenario analysis would allow them to be in a position to focus with the counterparties on how is the best way to transition, what are my options, and involved in early negotiation, early discussion in a kind of proactive manner will allow you a lot more time to be able to work through those options rather than trying to all deal with it towards second half of next year when I guess every participant's going to be banging on the door of the banks trying to figure out how to migrate certain positions. So yeah, that would be my certainly I guess additional comment to what Alex has covered.
Very interesting. Thank you, Ross. One other issue that comes up often as we discuss this in the market with broader market participants is a lack of clarity and a lack of if you will, the sameness around the conventions within markets across jurisdictions. Greg, as an issuer, how do you manage these different day counts, the different conventions, a different way of lookbacks, and how do you manage that? And how do you see that ultimately play out? And what are some of the key challenges that people on the buy side need to be aware of?
So I think it not just as an issuer, but as a participant in various markets, I think it's been a challenge to have an inconsistency between different structures which people are using in the market, and it's leading to probably less take up of those products, of the new alternative reference rate referencing products in the market. So the approach that we've taken is we sort of have to be prepared for whichever of the structures ends up forming a consensus around, and really being able to issue in any of those structures. There's the COVID period has really restricted the amount of issuance going on in these new ARR products as people were focused on other things. So that's been another challenge, which has sort of delayed, I suppose, the forming of a consensus around structure. There has been some progress made in the UK where they, early on in the period, they seem to form a consensus around the structure with a 5-day look back. In the US market, there's been various different structures issued, and it does seem to slowly be coming towards a consensus, but there are things changing as we go on. So the new Fed index is another type of structure which is being used in documentation over there, and we just have to be prepared and have our systems ready to issue wherever the demand is in those products. For the investors, for their part, mostly they've been open to the different structures. So if we've wanted to do one or another, they've been open to either structure. But I think having a consensus of what that looks like will be a great benefit to the market in general in adopting alternative reference rate issuance products.
Very interesting, Greg. Ross, Alex, if you think about these different conventions, can you call out specifically around operational risk management that you want to share with the broader audience?
Well, I'd really concur with what Greg explained. The first challenge is indeed going to be it's going to impact the complexity that brings kind of slowing down adoption. And I think indeed the amount of variation that we are seeing now in variation of contract terms is a little bit mind-boggling, especially in SOFA. So in terms of operation question, obviously this creates some kind of non-fungible basis risks in your book, which makes hedging less efficient. But then you have to deal with cash flow and PV mismatches, possibly issues as well for hedge accounting. So that brings a lot of kind of remediation processes around that. And mostly it brings kind of frictional cost and loss of efficiency through operational complexity, because you just have to deal with too many things, and potentially even lead to some kind of fragmentation in the market. Now, on the system side, I'd say we are, for instance, at Murex, and I'm sure it's the case for most providers, we're really committed to supporting all these variations. But this is a serious investment for system providers, and most importantly for our users who need to implement and validate all those changes in very little time. And as things are still not clear on many conventions, and that's the additional challenge. You need to deal with all those changes and build on shaky foundation in very little time. So there is that challenge. And then you've got an additional complexity with the fact that you have, with the fallback mechanism, additional variations with in terms of the contract that will be created through those fallbacks, which not necessarily exactly aligned with a new fresh contract to create on the same index, for instance.
Yeah, and not too much to add from my side, really. I think Alex has touched on a lot of the points. The want to have flexibility is clearly there. But obviously that comes with a cost, and getting the balance right between making sure that you're well prepared, that you've got flexibility to move to different transitional products is important. And obviously there'll be nuances. The way in which the sterling market is developed is much quicker than, say, the US dollar market. And therefore, you've got, a bit more of a convergence around conventions. I think the balance between the flexibility you want and the cost of implementing that flexibility is probably one of the key challenges that needs to be managed. And again, I'm going to keep mentioning this word, being proactive around this and building in that flexibility as much as you can, I think is the key aspect.
Now, and in terms of conventions, I'm looking at a question from the audience. If you just look at the cross-currency basis swap market, what kind of conventions do we think that's going to land on in terms of us being BBSW or an Aeonia-based offshore markets going risk-free rate in large part? How is that going to land, do we think? Can we predict how that's going to play out?
There's been certainly quite a bit of discussion, within the sort of AFMA part of the world about the impacts there. And I think the view was that the ISDA protocol and the decisions made through ISDA with regard to selecting which alternative reference rates, basically, and then having a calculation methodology for the fallbacks would dictate the direction of the market and the way it would form. There has been a view expressed, certainly here locally, that people will shy away from having the two legs of a cross-currency swap based on fundamentally different rates. It's been alluded to earlier that you've got a risk-free rate on one side and then still a traditional BBSW rate on the other side. That would create complexity. Where you get the tipping point, when the market moves, is a hard question as well. I also just want to touch on the previous comments about the complexity in the market, and this is certainly something, again, that has been discussed quite at length amongst the financial markets sort of membership within AFMA. Part of the reason why there is you need to allow a certain amount of experimentation and exploration at these times, because we are in a transition period, is that from a conduct risk point of view, you've got to avoid unilateralism. You can't have, say, the banks and some major interests and a few big houses just sort of deciding what's good for the market and simply imposing that answer on the marketplace. You've got to have a dialogue, and building that dialogue has been a very difficult exercise because of the need and the time it's taken to get the level of engagement that we all need. But it's very important that particularly the clients here feel that their interests have been looked after, that the products are appropriate, and when they do move to a new reference rate and a new calculation methodology, which is actually the real issue here about sort of spread calculations, as Alex and Ross have sort of alluded to, where the real complexities lie. You've got to ensure that both parties, but particularly the client, feels that outcome is fair. So one-size-fits-all solutions, certainly at this time, have not been possible. So the part of the difficulty is we've got to allow this sort of period of evolution and consensus to build through evolution and experimentation. Hopefully we'll come out, but that has been always the history of the markets in the past. If you look at how all these things developed back in the 80s and all the rest of it, there was always experimentation at the onset. It's just that now we're working through a force-paced transition.
Mm-hmm. Very interesting. So a lot of differences at the moment, but ultimately perhaps in the long run we'll see more conventions develop, if you will. I notice we're heading towards the end of this panel. We talked a lot of different issues, timing, the complexity. I think we understand. Certainly, we've illustrated the challenges that this entails, the importance of thinking about this holistically as an organization, of getting ahead of the challenge in front of us. If there's one sort of parting advice, and I'll open it up to each one of you, what will be sort of the key issue to take away from this meeting, and as you transition to those risk-free rates? I'll start with you, Greg.
I think I've got the obvious one. It's just to be prepared. I think this is it's a big project. It goes throughout the organisation, whether you're buy side or sell side, and there's a lot of people you need to engage, and you don't have a great deal of time. There's things happening right now in terms of the ISDA protocol. There've could be pre-cessation announcement happening soon, and there's only 14 months till we're pretty clear that LIBOR is going to be going away. So make sure that you've got your project started and you're making progress towards the end state.
Great. Ross, how would you summarize the key challenge?
Yeah, look, clearly we're now kind of into execution mode, and both on the bank side, I think they need to be engaging when outreaching to their clients and managing that process, as I mentioned, in a kind of auditable way to be cautious around the conduct side. On the client side, look, you should be expecting and wanting a lot of information from your banks. Your bank counterparties, but you should also be proactive in kind of seeking out independent advice and data and services to be able to assess the impact to your specific portfolio and manage that appropriately. So those are the quick 2 points I would make.
Alex, how would you summarize it?
Yeah, I would really echo the points that Greg and Ross just made. I mean, we've had about 3 years to prepare for this. Now we think the piece of the puzzle are falling into place. The picture is getting clearer. So I think it really is time to move from the planning to the execution phase. One piece of advice I would give is please don't underestimate the complexity of the tasks ahead. And also be careful not to address transition issues on a piecemeal tactical basis. So yes, you need now to focus on the fallback question, but then start working as soon as possible on your active transition as well, and don't miss the forest for the tree. I think what we are facing is really a deep, fundamental market transformation, and not just a one-time technical event. It's complex. We're learning a lot, and I think to finish maybe on the lighter note, I mean, the silver lining for me is that we are learning a lot for that process. So I'm sure we'll do much better when we'll discontinue so far and Aonia in about 30 years from now.
Very good, Alex. Thank you for that. David, any parting words?
Well, for anyone listening to this who is affected by what we've been talking about, and you've been ignoring the issue, hoping someone would give you a solution, hand you it on a platter, you better get thinking and take this really seriously. Basically, no one should be ignoring this. Everyone's got to take it seriously and look after their own interest. Think about your own interest and think about what you need to do. As you've heard, there's a lot to do. So don't ignore this issue as somebody else's problem.
Thank you, David. That's very helpful. Obviously, a lot of work for everyone ahead of us. Thankfully, we're all in this together, and we hope to speak to you soon again on this issue. Good luck, and thank you for joining us, and thank you to the panel members.